Okay, good morning. And are you working? Are you sure? Okay. And if you're online, you make sure you can hear me, that I'm not fading in and out. Working? I'm not hearing audio in my ear. If you're online, can you hear me good? Well,
barely good.
that's what I think. I don't think the earpiece is working. Okay, now is that better? Should be better now. Okay, so for whatever reason, the earpiece isn't working. That's why I didn't hear in my ear when you started recording. Okay, so we'll just do it this way. Okay, so today what we're doing is we are starting chapter 6, which is about inventory. Inventory is merchandise that we purchase and resell to customers. Now, what we're doing in the whole scheme of things in the book is we started close to the top of the balance sheet. We started not with cash, but right below that with short-term investments and receivables last week. This week is inventory. And inventory is on the balance sheet. It is an asset. So when you're answering this first question, it is an asset. So now it's down to two choices, current asset or long-term asset. And what distinguishes a current asset is it's something we expect to turn into cash or to sell within a year. And certainly we expect to sell our inventory within a year. So inventory is always a current asset. Okay, so make sure you get your answer in for that one. We're going to be talking about inventory today. Inventory is one of my favorite chapters, but I will warn you, it's one of the most confusing. So we're going to go through some really basic examples today. We'll step up to another level on Wednesday, but today I'm going to start out with some really basic examples, but bear with me because we'll use those same concepts going forward. So due this week is the Chapter 6 homework. The Chapter 6 homework is pretty lengthy. It will take you some time. Inventory requires practice. You're going to have to work your way through it, and it's the kind of thing that's not going to go fast. It's going to take some time. So with that in mind, I'm going to email out the step-by-step videos this week, either today or tomorrow, so you'll have those to help guide you. And my best advice on the homework problems is go step by step. Take it slow. It's not something you can just put numbers in your calculator and get a number. You're going to have to write it down. Okay. Once in a while I get a question about tutoring. Tutoring for this class is through the Academic Success Center. And last semester, the last couple semesters, they taught all kinds of hours. Well, it turns out very few people ever go for tutoring, so they've cut them back somewhat. But I wanted to say this tutoring link is on Blackboard, or if you go to the Academic Success Center at Kent State online, you do the drop-in tutoring. You see we have tutoring Monday through Thursday, but the bottom line there at Prentice Hall, Monday is the big day for tutoring for this class. It's available in Prentice Hall from 7 a.m. to 9 p.m. So those tutoring hours are there, and then a couple hours on the other days. Okay, so this class is about inventory. This chapter is about inventory and cost of goods sold. Inventory is on our balance sheet. It's merchandise that we purchase and resell to our customers. The reason the title says cost of goods sold also is when we sell it, inventory turns into cost of goods sold expense on the income statement. Okay, a couple abbreviations we're going to need in this chapter because when we write things down, these get kind of lengthy if we all write them all down all the time. Beginning inventory, BI, ending inventory, EI, and cost of goods sold, COGS. COGS is a common abbreviation in the workplace. So I'll give you a minute to write those down. Okay, now, so we're going to use these abbreviations as we go in this, we're going to use these abbreviations as we go in this chapter. Beginning inventory, ending inventory, cost of goods sold. So we're going to move on now, and we're going to get to the first example. Okay, so the first example we're going to walk through here is very basic, okay, but I think it illustrates the concept. So our basic example is we have a t-shirt business. So we buy t-shirts and we resell them. When we talk about inventory on the balance sheet or cost of goods sold, we're talking about our cost of them. So first thing we need to do is be able to know how many we have sold and how many we have left. Because the sold ones are going on the income statement, the ones we have left are going to be on our balance sheet. So here's our simple example. We start with 3 t-shirts. So that's our beginning inventory in terms of accounting terminology. But we start with 3, we buy 2 more. So when I ask you how many are available for sale, well, how many are available for sale is basically 5, right? So that's pretty straightforward. We're going to over and over and over, you're going to hear available for sale in here. Now right now we're talking about units. By the end of today, we'll be talking about dollars, but it's the same idea. It's what's the cost of those t-shirts that are available for sale. Anything that's available for sale during the month or quarter or year, whatever we're talking about, anything that's for sale had to come from one of 2 places. We either had to start with it, which is beginning inventory, or we had to buy it. That's it. Everything came from one of those 2 places. So the maximum number we could sell would be 5. We don't have any more than that available. Okay, so again, these are really basic numbers. We're going to put a little bit bigger numbers on it, and somehow that seems to get harder, but it isn't. It's the same basic concept. So next up, let's say we sell 1. So we sell 1 of our t-shirts. Now the question is, how many do we have left in ending inventory? Well, so how many we have left in inventory, that's pretty easy. We can visually see it. We can see we have 4 left, right? So we took what we started with, we added what we purchased, how many we purchased, and then we subtracted the one we sold. We know we end up. So we have just applied a formula without even thinking about it, right? Because we know we started with 3, we bought 2, so we had 5 available, we sold 1, we've got 4 left. Okay, that is a formula for inventory. There's 2 big formulas in this chapter, and that's one of them. The other one is just a version of this. So our beginning inventory plus our purchases equals available for sale. We subtract the number we sold. It gives us ending inventory. So that's one form of the equation. We're going to tinker with the words just a little bit, but that's what we just did. This is nothing magical. And it made sense when we did it. So when I say you have to know this formula, don't let the fact that it's a formula sway you. It is what we just walked through. Okay, so that is one. We're going to come back and see this again. So that's one. So let's go back to our inventory example. So let's say we have 1 left at the end of the year. How many did we sell? So we start with 3. We bought 2 more. We have 1 left at the end of the year. So we have 4 sold, right? Because we know we have 1 left. So that's the same way of looking at what we just talked about. So we can do that same formula and just switch these last 2 items. Okay, we could swap either one of these if we're looking for the other. I just want to test the audio. Is that still clear, or do I sound further away now? We started my Bluetooth. Tell me online. Still hear me, or is it further away? Okay, so I guess Bluetooth is done for today. Okay, just thought I'd try. Okay, so what we've got here is we're swapping the last 2, ending inventory of number of units sold, so we can solve for one or the other. we're going to keep going. I've got these formulas written on one page. So our basic inventory formulas are beginning inventory plus purchases equal available for sale minus beginning inventory number of units sold. Now you wrote that one down. I just substituted number of units sold. It's also cost of goods sold. So we can use this formula with both units or dollars. So we're going to do both of those today. And then the other version of this formula is simply flipping the bottom two terms. So we can take our beginning inventory plus our purchases, gives us available for sale, subtract our number of units sold, gives us ending inventory. So those are the two formulas we need. We can use number of units with these, or we can use cost. Okay, so what I'm going to do is I'm going to put up a question. So we should have question 24 coming to you. And this is beginning inventory consists of 10 units. 6 units were purchased during the period and 2 units are sold. So how many units are in ending inventory? My mind, I want to see. I can't do it. Okay, let's figure this out. Got too many things. Okay, so beginning inventory is 10 units. We purchased 6 during the period and 2 are sold. How many units are in ending inventory? This is the Learning Catalytics question. You have to put your number in and you have to press submit. Your answer will not go in until you press submit. Now, what we're doing here in this question, we're looking for how many units are in ending inventory. So going back to these formulas, over here, what we'll be doing is we will be using right here, we'll be taking our beginning inventory plus our purchases equals available for sale, subtracting our units sold to get our ending inventory. So when we go here, we have beginning inventory 10 units, 6 units purchased during the period, and 2 units are sold. A lot of correct answers. This is good. So we take our beginning inventory plus our purchase. So right there we have 10 units we had in beginning inventory, 6 units purchased. So we had 16 units available for sale. Now we sold 2 of those 16 units. So we have the 16 minus the 2 units gives us 14 units in ending inventory. So I'm going to close this in 5 seconds. Again, press submit on your answer to make sure it's in, because I'm missing about 10 students. So make sure it says your answer's been hidden, okay? Because you want to make sure you get credit. You have to press submit to get your answer in. Okay. Then as I said, your 10 units plus your 6 minus 2 gives you 14 units in ending inventory. Okay. Now, let's do one more. Applying that same set of formulas, this time we're going to solve for the number of units sold. So this time we're going to be solving for the top part here. Using the top formula, we're going to solve for the number of units sold. So our next question, next question. Beginning inventory consists of 12 units. 4 units are purchased during the period, and 3 units are in ending inventory. How many units were sold? Okay, so we have beginning inventory 12 units, plus we purchased 4 units during the period. So we had 16 units available for sale. And it's telling us of those 16 units, we have 3 left. So if we had 16 units total, we have 3 left, then that difference has to be how many units were sold. I'm going to close this in about 10 seconds or so. Last chance. I've got about 30 people. Make sure you're pressing submit on your answer. Again, 16 minus 3. Okay, so 16 minus 3, 13 units sold. So that's an example of how to apply that formula. We're going to go on and we're going to do, now we're going to start applying cost to inventory. At this point, we've just talked about the number of units. So we know we can track them. We know that all our units have to be in beginning inventory or we purchase them. That's what's available. And then at the end of the period, they either have to be in cost of goods sold or in ending inventory. So let's go through basic calculations. So going back to our t-shirts, assume that t-shirts can be purchased for $10 each. That's the cost, that's our cost of the t-shirt. So the cost doesn't fluctuate. We always buy t-shirts for $10 each. And when I talk about we're the business selling t-shirts. So we buy them from our supplier for $10 each. So our beginning inventory, 3 t-shirts plus purchase of 2. So our beginning inventory costs $10 times 3 t-shirts, $30. Our purchases were 2 t-shirts at $10 each for $20. So our total available for sale, the total cost of everything we had available for sale is $50. If we have 1 unit in ending inventory, it's 1 unit at $10 each. And then our number of units sold, our cost of goods sold will be 4 units at $10. So now we say, okay, well, our available for sale equals our ending inventory plus our cost of goods sold. So now we're applying dollars. So the last line isn't number of units sold. We're using the cost of goods sold there. Okay, so if this were the case, if our costs never fluctuated, we could almost be done with this chapter now. But we're not, because costs fluctuate. So now I'm going to show you the main reason that the rest of the chapter exists. Okay, and before we get there, a rule that we need to know, the total cost of beginning inventory plus purchases will always equal the total cost of ending inventory plus cost of goods sold. Okay, so our beginning inventory plus our purchase has to always equal ending inventory plus cost of goods sold. We're going to see that over and over. So now let's go into the issue. Now let's assume the only thing we've changed is we've said the cost of our t-shirts can fluctuate. So now we've still got the same number of t-shirts, we've still sold the same number, but our beginning inventory we paid $10 for each of those t-shirts. When we made the purchase this period, they were $15 each. So now things have changed. So when we look at this now, our available for sale, we have 3 t-shirts at $10 each, purchase of 2 at $15 each. But the ending inventory, do we value that at $10 or at $15? And then the cost of goods sold, do we value it at $10 or $15? The reason this is a big deal is cost of goods sold goes on your income statement. If you have more on your income statement, your income is lower. You might not want to show lower income to the bank or to your investors, or you might want lower income because you pay less taxes on it. So there's a choice. So this is a big deal. This can make a huge impact on a company which values they use. So not only could we look at the $10 and the $15, another answer could be, well, how about some average? Well, that's another choice too. So what we're going to do for most of the rest of the class today is I'm going to go through a very simple example with the t-shirts of 4 inventory methods. There are basically 4 inventory methods that companies have to choose from. They'll choose one method and stick with it, and then Wednesday we'll talk about a little bit about why you might choose a method. So we're going to go through this. And the first method that we're going to talk about is specific identification. Specific identification we will spend the least time on, but you do need to know it exists. Specific identification says we can identify which units we sold and which units we still have. This can only be used typically when we have something that's high cost and has serial numbers or unique identification. So we could use this for automobiles. They have serial numbers. We can track them individually. That's not a big deal. Aircraft, some high-end jewelry. But you're not going to do this normally for things like T-shirts because you've got thousands of T-shirts. You're not going to keep track of which T-shirt you sold specifically. But specific identification, let's say for our little example here, we're told that we have our beginning inventory, our purchases, and we're told that one of those ones from beginning inventory is left, okay? So we know, we're told this one. So the one that's in ending inventory is $10 because we're told that. So then our cost of goods sold is everything else. So beginning inventory, just running through the numbers here. Beginning inventory, we have 3 at $10, purchase 2 at $15. So our total cost of goods available is $60. That doesn't change. No matter what method we use, it's always going to be $60 in this case. Now, specific identification says how much is ending inventory? Ending inventory is $10 because we have 1 at $10. We're told it's that one from beginning inventory. So then cost of goods sold is going to be the other 2 from beginning inventory and 2 from purchases. So cost of goods sold will be $50. Okay, so our ending inventory of 10 and our cost of goods sold of $50 equals $60, which equals the total cost of goods available, so we are good. We have allocated things properly. Okay, so that's one method, specific identification. It's probably the easiest intuitively to understand because you can point to it and say, well, the $10 one's left. Now, we can only use that in very narrow circumstances. The next 3 methods can be used by companies. They pick a method and they stick with it. So we'll talk Wednesday about that choice. But today we're going to talk about the mechanics of the 3 methods. So, okay. Weighted average method. That's our first one. So our first one, we can't just take 10 plus 15 because we have different numbers. We have 3 at 10 and 2 at 15. So we use something called the weighted average method. And the weighted average method, what we're doing is we're taking our total cost of goods available divided by how many T-shirts and coming up with a weighted average cost. So first thing we're going to do is we're going to get our total cost available, just like we did. So it's the same for every method. Our total cost available will always be our purchase cost plus our beginning inventory cost. So our beginning inventory cost plus our purchases is $60. And our question, remember our question is how much of the $60 is sold and how much is ending inventory. So our weighted average cost, we take our total cost of goods available, divide by the number of units that were available for sale. So in our case, total cost available was $60. We had 5 T-shirts in there, so 60 times 60 divided by 5 equals $12. That's our weighted average cost. So now when we say what was our ending inventory? Our ending inventory was 1 unit at $12, a weighted average, so $12 value for ending inventory. And then we had 4 units not sold, or 4 units sold. 4 units times the $12 is 48. So what we end up with here is the 12 plus the 48 is 60, which equals our total cost of goods available for sale. So weighted average, you get the average, the weighted average cost, and then you multiply that by the number of units in ending inventory and by the number of units sold, and that's how you allocate that between. So weighted average is not bad. It's probably the second easiest method after specific identification. Where weighted average gets really messy, this is great for one period, but you can imagine what happens as you go forward and you have more periods and you have prior costs, and it can get really, really sticky over time. So that's weighted average method. Okay, so what we're going to do, what you're going to do right now is I'm going to put up a similar problem, okay, and you're going to answer. So we're going to put up the next problem, put up the question in a minute, okay. So this is the example, and you will be using this example for all three methods, so you may want to leave lots of room around it. So the facts, beginning inventory, December 1st, was 10 units at $12 each. So if I were doing this and I were sitting in your shoes, I would write 10 at 12 equals 120. So that's your beginning inventory. So do a little bit of math as we go. Purchases on December 10th, 5 units at $15 each. I would just do the 5 times the 15. That would give us 75. And then 7 units left in ending inventory. Now I haven't put up a question yet, but I want to show you. We have beginning inventory. We have beginning inventory of 10 units plus purchases of 5. So that gives us available units available for sale of 15, right? So we have 15 available, and then I told you we have 7 units left, okay? So you had 15 units available for sale. You have 7 left. So that leads us to our first question, okay, is how many units were sold in December? We had 15 available, okay? We have 7 left. So how many did we have to have sold in December? We're not doing any cost right now. We're only talking about units. Okay, so how many units were sold in December? Most of you have the right answer. We're around 95%, which is good. But when we're talking about this, how many units were sold in December? Let me see. Still waiting for like 100 of you to answer, so you need to get your answer in before this closes. But we're saying that we had beginning inventory of 10, purchases of 5. So there were 15 total available, and we are told that we have 7 left. So we had 15 available, we have 7 left. To get from 15 to 7, we had to have sold that difference there. So basically 15 minus 7 is going to give you this answer. So I'm going to close it in about 10 seconds. And again, it's 15 minus 7. Got a fair amount of arithmetic today, just basic multiplication for the most part. A little bit, one thing for division, but basically subtraction. Okay. 15 minus 7 times up in 3 seconds. Okay, so the answer is 8. That was 15 minus 7, the beginning inventory plus purchases minus the 7 units. I will tell you, you have to know that. The basic formula is on your exam reference sheet, but when you take the exam, you'll need to know that. You'll use it in the homework. Okay, so now, how many units were sold? Somewhere in your notes, you need to write down 8 units sold because you're going to need it as we go forward. And again, we're using the same example over and over. Okay, so next question. What's the weighted average cost per unit? So this gets a little more, we've got to do a little more work for this one. Remember how I said your beginning inventory, you would take 10 units at $12 each, and that was 120 over the 120 written in the margin? And then you have purchases, 5 units at $15 each, that's 75. So you basically have 195 as your total cost of goods available. You would take that 195 and divide by 15 units. Where did I get 15 units? That's how many units were available for sale. We had 10 in beginning inventory and 10 in purchases. So I'm going to put this one out there. Okay. So weighted average cost, you're going to take your total cost of beginning inventory plus purchases and divide by the total number of units in beginning inventory plus purchases. Okay, you're looking for the weighted average cost per unit. Just a reasonability check on this. You had beginning inventory at $12 each. You had purchases at $15 each. You know right off the bat, your answer has to be somewhere between 12 and 15. Your answer cannot be 100 or 200, okay? Your answer has to be somewhere in there. So, weighted average cost per unit, you're going to take your total cost of $195. How did I get that? I took the 10 units at $12 each, added it to 5 units at $15 each. So that totaled the total cost of my beginning inventory plus the total cost of my purchases was $195. I'm going to divide that by 15 units. Where did I get the 15 units? That would be my beginning inventory of 10 units plus my purchases of 5 units. That will get me to this correct answer. And the word weighted is very important. I didn't ask for average, so you just can't take the 2 and divide by 2. Weighted average reflects how many units of each at each cost. So weighted average cost per unit. Okay. We're going to close it in about 5 seconds. Okay. Third question. Now, okay, so now we're on to the easy stuff. You've done the heavy lifting for the weighted average. What's the value of ending inventory? Value of ending inventory, we've got 7 units left, and we just calculated that the weighted average cost per unit was 13. So you do a little multiplication there. 7 units at $13 each. Okay, so ending inventory, we've got 7 units left, right? We said 7 units at $13. Where did we get 13? That was the weighted average cost. So you're simply taking 7 times 13. I'm going to close the question in about 5 seconds. Okay, so it was 91. This is specific identification. You're taking the number of units times that $13. Now the next question, what's the cost of goods sold? This one will be really straightforward. You're going to take how many units we sold. Remember I said write down how many units we sold? We sold 8 units. We sold 8 units. So you're going to do the same thing you did in question 3. Instead of 7 units, you've got 8 that you sold. Okay? So you're going to do the 8 times the 13. Okay, so we're doing the 8 units And the 8 units that we sold, where did we get that? We did it back a couple questions ago. 8 units sold times the $13 cost. You're going to multiply that. We're going to close the question in 5 seconds. Okay, so it is 104. It's at 13 times 8. Okay, so weighted average. That was one method. Now, we get into the next two methods, which cause probably the most angst. But it's doable. You just have to slowly go through. And when I do these methods, I myself actually write things down. We're going to be doing FIFO first. FIFO is first in, first out. FIFO refers to the flow of cost. So FIFO means our oldest units are sold first. I would write that down next to FIFO. Oldest units sold first. FIFO means oldest units sold first. It also means that newest units are in ending inventory. So newest units in ending inventory. This is under FIFO. Okay, so what we've got here is we've got beginning inventory, so we're back to our t-shirt example. Beginning inventory costs $10 each, purchases $15 each. Notice that my total cost has not changed. Beginning inventory plus purchases is going to be the same no matter what method we use. So now we're looking at cost of goods sold. I sold 4 t-shirts in my example. Under FIFO, what I sold, first in, first out, means that I sell my oldest units first. So my oldest units are beginning inventory. So I sold 3 units from beginning inventory. I have 4 units I sold. So I'm going to start at the oldest end. So the oldest end is I sold all 3 of those beginning inventory t-shirts at a cost of $10. Now notice, I'm not talking about selling price. I'm talking about what they cost. So I sold the 3 ones that were in beginning inventory. I also, since I sold a total of 4, I also sold 1 from my purchases. Okay? So my total cost of goods sold under FIFO is $45. Okay? So I had my FIFO means our oldest units are sold first. First ones in or first ones out. So we sell our oldest first. So we sold 4 units. We're selling the 3 from beginning inventory and then 1 from purchases. So my total cost of goods sold under FIFO is $45. Then my ending inventory under FIFO. FIFO means that my newest units are in ending inventory. And I have 1 left, and that's going to be at $15. So then if I take my $15 plus my $45, so ending inventory at $15 plus $45 cost of goods sold, it's going to give me total cost of $60, which is where I'm back to that. Okay? So again, FIFO, as soon as I see a problem that says FIFO, the first thing I do is I think in my mind that FIFO means that my oldest units are sold first and my newest units are in ending inventory. Okay, so now the same example we've been working on. Beginning inventory, 10 units at $12 each. Purchases, 5 units at $15 each. So in your notes already, you should have beginning inventory is $120, right? And purchases were $175. So combined, that's $195 cost of goods available. That should absolutely be in your notes. It's going to be the same no matter what method we're using. So the cost of goods available for sale is $195, just like it was for weighted average. It will be the same. So that should be in your notes. There's 7 units left and 8 units were sold, so nothing has changed. So we're going to do some questions and walk through FIFO now. Okay, so the first question, what's the total cost of inventory available for sale? Remember, it doesn't change. Okay, total cost of inventory available for sale. That will be your beginning inventory, the $120 in beginning inventory, plus the $75 in purchases. So the $120 plus $75 is $195. It's the same answer as with weighted average. It doesn't change, so it's $195. You need to get your answer entered, and I'm going to close it in about 5 seconds here. Okay, I have someone that entered a dollar sign. Make sure you've entered it as $195 without a dollar sign or it's wrong. Thank you. Okay, total cost of inventory available for sale, that will not change. You may want to make a note in your notes here, like the little star. When we do LIFO, I'm going to ask you the same exact question. The answer will be exactly the same. I want to emphasize the cost of goods available for sale does not change. It doesn't matter what unit method you're using. Cost of goods available is always your beginning inventory plus your purchases. Doesn't matter. And we're talking about the cost, so it's dollars. Okay, so now our next question, this is where it gets more challenging, okay? And this is where I'm not going to put the question out yet. I want you to kind of walk through the answer with me. So, what is cost of goods sold? Cost of goods sold. Now, this is FIFO, which means our first ones in are the first ones sold. So we are selling our oldest units first. So those oldest units, we look at this, first of all, we know 8 units were sold. So we look at this, beginning inventory are our oldest units. We had 10 units at $12 each. So we sold 8 of those. So 8 at 12 is where we're going with question 6. Okay, again, FIFO means that we're selling our oldest units first. Cost of goods sold. We know we sold 8 units. Those 8 units were from beginning inventory. Beginning inventory was $12 each. So 8 times 12 is your answer. I'm going to close this in about 5 seconds. Okay, couple more seconds to get your answer in. 8 times 12. Okay, so it's 96. We had 8 units at $12 each. Our oldest units are sold first. Okay, now for the next question, again, I'm going to wait to put it up there, but it's talking about ending inventory. When we're at this point, this is the easiest question you can do. That's because we know our total cost. Our total cost is $195 from question 5 up there. So that's our total cost of everything we had available for sale. Now question 6, we said we sold $96 worth of it. So if we have $195, we sold $96 worth. $195 minus 96 is going to be our ending inventory. Another way we could do this is ending inventory. We could say, well, under FIFO, ending inventory has to be our most recent units. We have 7 units in ending inventory. That means we're going to take 5 from December 10th and 2 from December 1st. Much easier way is to say, I know my total costs are $195. 96 of it was cost of goods sold. So the difference between $195 and 96, 195 minus 96, is going to be our ending inventory cost. Okay, so it's available now. Do you want to get your answer in now? Okay, again, your ending inventory, the easiest way to get it is take your total cost of $195, subtract the 96 as cost of goods sold. What's left has to be our ending inventory. So I'm going to take another 5 seconds and then I'm going to close it. Make sure that you submit your answer. You've got to put your answer in and press submit. Make sure your answer's been hidden for privacy. Okay, so it's 99. And we have 2 ways we can do that. The easiest way is going to get your total cost and subtract your cost of goods sold since we already did it. Okay, so that was FIFO. FIFO means that we're selling our oldest units first. So first in, first out. Our other method, the 4th and final method we have is going to be the LIFO method. LIFO means last in, first out, which means we're selling our newest units first. Okay, so back to our t-shirts. So now we're going to do LIFO. First thing with LIFO is, again, we know that our total cost available for sale is $60. Our cost of goods sold, LIFO means these are the most recent units. So we're going to have 2 of the purchased t-shirts at 15. And then we're going to, since we have 4 units sold, we're also going to take 2 of the beginning inventory at 10. So our total cost of goods sold under LIFO is going to be $50. So LIFO, we're selling the most recent units first. So we're going to sell both of those purchases, both of the t-shirts, the purchased ones at $15 each, but then we sold a total of 4, so we have to go back and get 2 more from beginning inventory. Okay, so we have total cost of goods sold of $50. Now right now I know what my ending inventory is going to be because I have total cost of $60. I just said cost of goods sold $50, so the difference has to be 10, but we can also say for ending inventory we have 1 t-shirt left. Under LIFO, our inventory is our oldest unit, so we would have 1 at $10 left. So we have $10 in ending inventory, $50 in cost of goods sold. Those combine to be $60, which is our total cost of goods available for sale. Okay, so we have the LIFO method. Our next one, okay, we're back to our same example that we've been using. Okay, so all the data is the same. The first question, you should absolutely get it. This will be the 3rd time we've seen this question. The answer does not change with the method. This is, what is our total cost of inventory available for sale? That's basically asking you what's the cost of beginning inventory plus the cost of purchases. And it's the same. It doesn't matter what method we're using. Okay? So the total cost of inventory available for sale is going to be the cost of the beginning inventory. Cost of beginning inventory, 10 units at 120 at 12 gives us 120, plus the purchases, 5 units at 15 each, 75. So we're adding the 120 and the 75 together, and so our total cost of inventory available for sale. Okay, get your answer in. I'm going to close it in about 5 seconds. Okay, so, now with LIFO, what is ending inventory? Ending inventory, there's 7 units left in ending inventory. Under LIFO, ending inventory is our earliest inventory. LIFO means we're selling our most recent purchases first, so LIFO is our oldest stuff. Our oldest stuff in ending inventory is the beginning inventory. So beginning inventory, we've got 10 units in beginning inventory. We're looking at our ending inventory, there's 7 left. So what we're going to do here is we're going to take the 7 units in ending inventory times the $10 cost, because we took them from beginning inventory is the assumption here. $12. Okay, before I put this question up, when we're doing the ending inventory, it's 7 units left in ending inventory times the $12 cost from beginning inventory, okay? So it's going to be 7 times 12. Okay, so the question should be out there for you. Went from 0 to 101 answers. Okay, so that's that $12 beginning inventory cost each times the 7 units left in ending inventory. Okay, so just simple multiplication, $12 times the 7 units left in ending inventory. $12 times 7. Going to close this in about 5 seconds. Okay, so it's 84 is 12 times 7. Okay, now my next question I'm going to put up, I don't have it up yet to you, but cost of goods sold. This one should be super easy at this point. This is the one where you're going, this is easy. I have 195 total cost of goods sold. I know that $84 of it is ending inventory, so the rest has to be cost of goods sold, right? Because you have 195 total cost available for sale. We know that 84 is sitting in ending inventory. The rest of the 195 has to be cost of goods sold. Okay, so cost of goods sold is going to be your total cost available, 195 minus 84. It's going to be closing this question soon, the next 5 seconds or so. So 195 minus 84. Okay, cost of goods sold then is the 111, and that's going to be the 195 minus the 84. You can also go back and pull 5 units from purchases and 3 units from beginning inventory if you want to do it that way. So what we've done now is you've been exposed to all four methods, and we're going to do more practicing, but what we're going to do next is talk about the balance sheet. So that was like an introduction to the chapter, an overview of all the concepts we're talking about in the chapter. Now we're going to go back and talk about what all this means. So inventory is an asset. You want to make sure you know that. You want to make sure you know it's a current asset. Current asset means it's going to be turned into cash in the next 12 months or so. Okay? Cost of goods sold is an expense. It's typically company's biggest expense. Even though it doesn't say expense, it is an expense. Okay, so inventory is a current asset. Cost of goods sold is an expense. Assets are on the balance sheet. Cost of goods sold is on the income statement. Okay, now, we have something called the selling price, sales price, selling price. That's what we sell it to our customers for versus cost, what it cost us to buy it. So sales revenue is based on the sales price or selling price of the inventory sold. Okay? That's the only time we use the selling price. The selling price is what we're selling it to our customers for. It's easy to get these two terms messed up, and it's a big deal. Selling price is what we see on the income statement for sales revenue. Now, cost of goods sold on the income statement is based on the cost, on what it costs us. So that's where we're saying which inventory method do we use. We determine the cost of it. And then inventory on the balance sheet is based on the cost of inventory on hand. So we could kind of go number of units of inventory on hand times the cost of units. Now, if we use FIFO or LIFO, we have to modify that somewhat. So it's not always that straightforward. But cost of goods sold and inventory are based on cost. The selling price is what we charge the customer, and that's only used when we're calculating our sales revenue on the income statement. Okay, so that's really important to note because we're having a question coming up on it. We'll have questions. You need to know that cost is used for cost of goods sold and inventory. So cost is used for cost of goods sold. That's an income statement account. Cost is used for inventory on the balance sheet. Only selling price is only used to calculate sales revenue on the income statement. So we're using cost for both inventory and cost of goods sold. It's our cost. It's what it cost us. Okay, the formula at the bottom, can't use it most of the time when we're talking about FIFO and LIFO. It's kind of a general idea. But cost is used for inventory and cost of goods sold. Selling price is only used on sales revenue, for calculating sales revenue. Okay, so that brings us to our next question. Inventory is presented on the balance sheet at the selling price of the item. True or false? Okay, inventory is presented at on the balance sheet at the selling price of the item. 87% of you have it right, but what we're talking about is we're talking about inventory on the balance sheet based on the cost of inventory on hand The selling price is only used to calculate revenue on the income statement. When we're talking about inventory on the balance sheet, we actually present it at the cost, not our selling price. We do not value inventory at what we have it for sale at. We value it at our cost. So you're going to have a few more seconds to answer that. Okay, and that is false. That's at the cost of the item. Okay, so at this point, we're to where we were in the early class. So we're going to stop here, and on Wednesday, we'll pick up and we'll go methodically through the remainder of the chapter. So I'll see you on Wednesday.